Well, stocks indeed rallying on the heels of the Fed decision and Fed Chair Jay Powell's news conference, where the central bank maintained its outlook for 2 rate cuts this year. The tech-heavy NASDAQ outperforming, rising roughly 1.5%. Joining us now, David Sekera, Morningstar Chief US market strategist. So, David, interesting to see, as we were just talking about, this kind of cyclically led rally in the wake of the Fed, consumer discretionary tech helping lead the way here. What do you make of it?
Yeah, well, first of all, I kind of have to joke, but I'm not really joking. I don't think I've ever heard Jerome Powell use the word uncertainty as many times as I've just heard now. And I'm just looking at the market reaction. To some degree, I'm a little bit surprised by just how much the market was moving today. I think at the end of the day, the market's really just comforted that it appears that the Fed's not necessarily overreacting to the potential inflationary consequences of tariffs, as that would just only make the growth hit worse than it otherwise would be. And looking at some of the other numbers here that they've changed, at the end of the day, our U.S. economics team is not changing our views on either inflation or the economy. They're still holding to their view. They're looking for 3 rate cuts this year, so that's certainly going to be an out of consensus call at this point in time, and then looking for ongoing rate cuts next year as well.
David, sort of zooming out coming into this meeting, I'm curious how you were thinking about the market and maybe where we've sort of unwound from a valuation perspective. Of course, I believe you were in this camp, many people in this camp, that the S&P 500 was overvalued. Valuations were stretched coming into the year. Well, you take a look at FactSet data for forward 12-month earnings, the S&P 500, we're really just sitting about average right now over the last 5 years. It hasn't unwound that much. Are valuations low enough now and re-rated to the right level where you're more interested in U.S. equities, or are we not quite at that point, this point, where it feels like it's a definite buy, valuations are too low?
Well, we're really pretty close. I mean, right now we do have, valuations at what I would consider to be at the bottom of the range that we still consider to be fairly valued. So again, overall, depending on your risk tolerances, I would look to have a market weight overall in U.S. equities. But I still think positioning is just as important now as it was at the beginning of the year. At the beginning of the year, we were recommending to overweight value stocks, underweight growth stocks. At the beginning of the year, growth stocks in general were trading at some of the highest valuations and greatest premiums over our valuation since we've seen really since early 2021, and that of course was the top of the disruptive tech bubble. So year to date, the Morningstar US Market Index through yesterday's close was down a little over 4%, but it's really the growth index that was down the most. That was down over 8%, whereas value actually was up 3.4%. Having said all that, I do still see better value in value stocks going forward, specifically those value stocks with relatively high dividend yields. We have seen that sell-off in AI. In fact, I kind of really consider this a bear market right now in artificial intelligence stocks. Those stocks across the board are down 15 to 20%, some cases even more. Now they're getting to the point where a lot of those are 3-star, so puts in the range of fair value, but only starting to see a handful that have fallen enough that they're actually now looking attractive. A couple that we do like today would be Amazon. That's a 4-star rated stock at an 18% discount. ServiceNow, I think, looks pretty attractive. That one's down at least 30% from its high. It's a 4-star rated stock, trades at a 15% discount. And then for those investors looking for something that might be a little bit more speculative but have some more upside, I'd highlight Marvell. That's down 45% from its high. It's a 4-star rated stock at a 24% discount. But there's still some other AI stocks we think still have further to fall. ARM is going to be one of those more overvalued stocks under our coverage. It's a 1-star rated stock, trades at over a 60% premium to our fair value.
David, I'm curious, you mentioned bear market for AI stocks. There was one firm out there, Capital Economics, that had a note out today that essentially suggested if that bear market were to continue, then maybe the S&P 500 could enter a bear market even without a recession, just given how large the market caps are of a lot of those AI companies. I mean, is that a case that you could see playing out where we just keep selling mega cap tech to the point where the index gets weighed down too much?
Yeah, some of the mega cap tech is still a little pricey at this point, but if it were to fall and get back to our fair valuations, I don't think that would be enough to get us into a bear market overall for the S&P 500. So I'm not necessarily concerned about that. What I really think is that this is just a continuation of the theme that we highlighted early this year. So for 2025, I think this is the year that investing in AI really starts to evolve away from the hardware names, the GPUs, the networking names, In the old gold rush adage, people said it wasn't the miners that got rich, but it was the people that sold the picks and the shovels. That's last year's story. This year's story and going forward is going to be identifying those companies that can take AI, incorporate it into their own products and services, use that to help drive revenue, come up with new and novel use cases for it, as well as those companies that can take AI, put it in their own business processes, drive efficiency, be able to drive, additional operating growth in their margins. Those are the companies that I think are going to be the next wave to look for, for that trade.
And David, I know that something you brought up in your notes, one of your colleagues writing that tariffs were not the real cause of the market sell-off, that it was more to do with this recalibration or repricing of the AI trade. But if that is the case, and we do start to get more deteriorating hard data, economic data, as a result of the tariffs actually being put in place rather than just anticipation of them, doesn't that imply there could be, in other words, if this wasn't the pricing in of the tariffs, do we still have to get to pricing in of the tariffs?
Well, and I think you have to be very careful, when you're talking about the potential impact, of the tariffs. And a lot of people, are still talking about the existing tariffs that are put in place right now, the across-the-board tariffs with Canada and Mexico. But, in my own opinion, when I think about what's going on with the ongoing negotiations, those, in my mind, aren't going to be the tariffs that are going to be in place, 6 months from now. So I think it's really trying to understand, what the longer-term perspective of the tariff negotiations are. I think President Trump and his administration are probably trying to put together a new trading bloc with Canada and Mexico. Once we have that new trading bloc, probably bring in, some South American and Central American countries as well. I suspect afterwards he probably targets the EU next to be able to renegotiate trade terms there. But then I think really the big and more interesting negotiations will be once we have these trading blocks put together, then going and renegotiating with China. So I think, the tariff uncertainty, and again, I hate that word uncertainty, but there I am using it, that really is going to be something we're just going to have to live with in the markets, probably for, at least, the next couple quarters.
David, I think we're all getting sick of the word uncertainty, but it doesn't seem to be going anywhere for now. We're going to have to leave it there. We'll talk to you soon.
All right. Thank you.